Welcome, everyone. If you're a tax professional or a student navigating the new tax laws, you're in the right place. Today, we're going to demystify a really crucial provision, Section 72 of the new Income Tax Act 2025. We'll break down exactly how this changes the game for computing capital gains.
So let's start with a scenario you see every day. Your client has just sold a capital asset. Now what? Getting that taxable gain calculated with precision is absolutely non-negotiable, right? The 2025 Act is all about simplification, but that just makes mastering these core computation principles more important than ever.
Here's a quick look at our roadmap for this explainer. We'll kick things off by decoding the section itself. Then, we'll dive into the core formula. After that, we'll tackle some special scenarios, run through a practical example, talk compliance and pitfalls, and finally, wrap it all up with a handy checklist. So, let's get started.
Okay, let's jump right in. Think of Section 72 as the brand new foundation for all capital gains computations. If you're familiar with the old 1961 Act, this is essentially the successor to the well-known Section 48. It lays out the fundamental rules for figuring out the taxable income when a capital asset is transferred.
So what's the main goal here?
Well, it's all about creating a clear, structured, and straightforward method. The whole push of the 2025 Act is towards simplification, and Section 72 really embodies that by putting the entire mechanism into one single comprehensive provision.
Now, let's see how this foundation actually builds into the calculation. This is where we get into the nuts and bolts of it all, and you'll be happy to know it's all very logical. On the screen, you can see the heart of Section 72, subsection 1. It's really just a simple three-step process. You start with the full sale price, that's A. Then you subtract two things, B, which is your direct transfer expenses, think brokerage fees, and C, which is the asset's cost of acquisition and any improvements. What's left over? That's your capital gain. Simple as that.
Let's quickly break down that first piece. The full value of consideration is, well, pretty much exactly what it sounds like. It's the gross amount, the total value that the seller either received or is entitled to receive. This is the starting point for everything, so getting this number right is absolutely critical. Now, this next point is absolutely central to long-term capital gains. You've got your cost of acquisition, which is just the simple purchase price. But Section 72, subsection 2, gives us this fantastic benefit called the indexed cost for long-term assets. By applying the Cost Inflation Index, or CII, we get to adjust that original cost for inflation. This is so important because it means you're being taxed on the real increase in the asset's value, not some imaginary gain that's just a result of inflation over time.
Of course, tax law is never just about one simple formula, is it? It's those special scenarios, the tricky cases, that often test us as professionals. So let's look at a couple of really important ones that Section 72 and its related rules cover.
I'm sure this is a question many of you get all the time. You have a non-resident client who invested in an Indian company using, say, US dollars. Years later, they sell. But in that time, the rupee's value has fluctuated. So how do you make sure the tax is on the actual gain, not just on currency movements?
Well, the good news is that Section 72 keeps the same protective mechanism we had in the old Act. As Rule 52 spells out, it lets non-residents compute their gain in the original foreign currency. Basically, you convert the sales price and any expenses using the buying rate on the transfer date, and you convert the purchase cost using the selling rate on the acquisition date. This completely neutralizes the impact of currency fluctuations on the final tax bill. It's a really fair provision.
And here's another one to keep on your radar. Sometimes, when a partnership firm or an AOP is reconstituted, Section 67, subsection 10 can actually create what's called a deemed transfer. When that happens, Section 72, subsection 5 kicks in and says that the amount taxed there has to be attributed to the firm's remaining assets. The exact method is going to be laid out in the rules, and believe me, this is an area the department often scrutinizes during assessments. All right, theory is one thing, but nothing makes it stick like a real-world example, right? Let's put all these pieces together and walk through a calculation from start to finish.
We'll use a super common scenario, the sale of a residential house. It's been held for many years, so it qualifies as a long-term capital asset, and the sale is happening under the new Act in the tax year 2026-27. So here's our data. The sale price is 2 crores. The property was bought way back in 2011-12 for 50 lakhs, and the CII, or Cost Inflation Index, for that year was 184.
For the year of sale, we'll use a hypothetical CII of 380. And finally, they were transfer expenses of 2 lakh rupees. Now, the first and most important step for a long-term asset is to calculate that indexed cost of acquisition. The formula is really straightforward. You just take the original cost and multiply it by the CII of the sale year divided by the CII of the purchase year. And here we go. Let's plug in the numbers. Look at that. The indexed cost comes out to over 1 crore 3 lakhs. You can immediately see the power of indexation. It's more than double the original cost base. Next, we add our 2 lakh transfer expenses to get our total deductions. And finally, we subtract that total from the 2 crore sale price, and we arrive at our taxable long-term capital gain of just under 95 lakh rupees. Knowing the formula is only half the job. As professionals, ensuring our clients are compliant and helping them steer clear of common mistakes, well, that's where we really prove our worth. So let's focus on 4 key compliance points. First, documentation is everything. Keep every single deed, invoice, and receipt. Second, if you're dealing with a deemed transfer, a valuation report is not optional, it's mandatory. Third, when filing, be meticulous about using the correct codes in the new ITR forms. And finally, always keep yourself updated on the procedural nitty-gritty in the latest income tax rules. And just a quick word of caution here. 2 of the most frequent errors we see are 1, picking the wrong CII number for a year, and 2, just not having proper proof for transfer expenses. Both of these can lead to incorrect calculations, which could invite unwanted attention and maybe even penalties. All right, we've covered a lot of ground today, so let's boil it all down to the absolute essentials. We'll wrap up with a final checklist to help you remember the most important points. Here are your 4 key takeaways. Number 1, the basic formula is king. Master it. Number 2, for long-term assets, indexation is your client's best friend. Use it. Number 3, always be mindful of the special rules, especially for non-residents and deemed transfers. And number 4, and this might be the most important one of all, document, document, document. Your records are the bedrock of good tax compliance. And that brings us to a final thought. Understanding how to do the calculation is one thing, but using that knowledge to give your clients proactive, strategic advice, that's the next level. How can you help them structure their future transactions to be as tax efficient as possible under this new framework? That's really the key question to take away from this. Thank you so much for watching. If you found this explainer useful, please do give it a like, subscribe for more content, and share it with your colleagues. And just a reminder, this video is for educational purposes only. Tax laws are always subject to change, so please consult your professional advisor before taking any action. This is an AI-generated educational video.